One of the losers in today's market that we mentioned earlier, GameStop, that stock under pressure. But really more broadly speaking, short selling is in focus after lawmakers pressed the CEOs of Robinhood, of Citadel, of Milton Capital, just to name a few yesterday. For more on this, we want to bring in Joe Saluzzi. He's of Themis Trading. He's a co-founder there and co-head of equity trading. He joins us now on the phone. And Joe, there's a lot to get into yesterday's hearing. I think the big takeaways, at least for us, we were talking before the show, was short selling and then payment for order flow. So let's start on the short selling real quick. I guess the big debate is whether or not there needs to be more transparency around it right now. What do you think?
Well, thanks, Sean, for having me. I think, short selling it's not an evil thing. It's actually a healthy thing for the market when you think about it. Some short sellers will expose poorly managed companies. They will, be an activist style investment where they're coming in at a different angle. And it's extremely risky to be a short seller because your losses are infinite when you think about it, right? Because as the stock goes up, you're losing money. But transparency, it's a difficult thing because as Melvin Capital realized, once people realize that you're short, once they see you're short, they could put a run on it. And then that's where you will get squeezed out. So I think it's difficult. If you had a 5-10% holder like you do on the long side, on the short side, maybe there is some valid reasons to identify that as a long-term short holder, but shorts tend to come and go pretty quickly. So I don't know, to be honest with you, what's the right answer in transparency. All I can say is that it's not a bad thing, short selling. What's bad is when you don't have a borrow, and it's called what they call naked short selling. That's illegal, first of all. And if that's going on, that's where the regulators need to get involved.
Joe, we're going to continue with short selling, but got to bring in pay for order flow. And this seems to be getting a bad rap. For instance, like Citadel Securities, they make their money on the spread between the bid and ask, but you need to have huge volume in closing deals for retail investors to do that. Is this something that we should be looking at?
Yes, and I was thrilled actually when I did hear a little bit more about that in the hearing yesterday. We've been studying market structure for years now, and it's really kind of market structure plumbing is difficult. When you press the button to buy a stock and you come back and you get your report, there's a lot that goes on from the time you hit that button to the time you actually get that execution, even though it seems like it's instantaneous. But it goes through this maze of routing and different spots where it might go into a dark pool, it might go into a market maker, it might go to an exchange. But part of the inner workings of the market is where a retail broker will sell that order flow to a market maker like Citadel, and in return, Citadel will give some sort of price improvement, right? Or market makers will give price improvement. Well, in our opinion, what happens is all of the flow, if it was a small amount of flow, it really wouldn't matter, but now you're dominating. It's almost 50, right now, the retail market is about 35% of the volume that we're seeing out there. All of this flow is being traded off of the exchanges. And what we think is happening is, and the reason why it's off exchanges is because of the payment for order flow, it's hurting the price discovery process. In other words, the orders are not making it to an exchange where they can interact with other retail orders or other institutional orders, mutual funds, pension funds, and so on. And it's being intercepted by the market makers. And the market makers do that, and they pay for that because they want to see as much as they can. And that's the way their business works. The more they see, and in this business, it's always been about information. The more information they get, the more they can predict which way the markets are going, the more they can, model their own book. So we think in the bottom line is payment for order flow, we've always been against it. And not only from the market maker side, but also the exchanges do it as well. But it's something that distorts routing, and we don't think it's necessary.
Market microstructure. I want to get your take on Citadel CEO Ken Griffin's kind of putting this idea out there. And it's been out there for some time of getting sub-penny fills back. And I know it gets really wonky here, but I see this basically taking an issue that you have with these dark pools and these market maker matching algorithms and just kind of bringing them back on the exchange. I'm just wondering, is it possible or even likely that that just reduces future transparency and also liquidity?
Well, thank you for that. By the way, we've been around for a while. It's feeling pretty old now. But this is, it's a topic that doesn't go away, right? And you're right. It's a difficult one when it comes to transparency. When you're trading off exchange, and we trade off exchange as well as institutional investors. Now, I trade on behalf of institutional investors, right? So my clients are hedge funds, mutual funds, pension funds, and so on. And oftentimes during the day, I'm trading on dark pools. I'm trading through, various ones that are institutional sized, and that's where we're putting up blocks and we're getting more liquidity. Now, is that transparent? No, that's not. And someone can make an argument that dark pools are not transparent either. But what we're trying to do is minimize our transaction cost. And if I can do that and match up with another institutional investor, well, that's a good trade in our opinion, without the intermediary getting in between. What happens on the retail side of the market is the market maker is an intermediary and he touches every order.
Go, go, woo.